Q1FY24 earnings conference call of SBI Cards and Payment Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rama Mohan Rao Amara, MD and CEO. Thank you, and over to you, sir.
Thank you, Yashasvi. Good evening, everyone. I am pleased to welcome you to the Q1FY24 earnings call along with my senior management team. I also take this opportunity to introduce Mr. Shantanu Srivastava, our Chief Risk Officer. This fiscal is special to us as it marks a key milestone in the organization's history. As you are aware, SBI Card celebrated its Silver Jubilee on 15th May this year. Through these years, the company has exhibited business resilience and strength to stand the test of times. Our customers' patronage and trust have been instrumental in our success, and we remain committed to delivering value and growth to all our stakeholders. As we meet today, the global economy continues to be impacted by the prolonged geopolitical tension and volatility in global financial systems. However, India is well poised to sustain its growth momentum. In its annual review report, Ministry of Finance has said that Indian economy appears to grow more durably than before. India's GDP has grown by 7.2% in FY23 as against an earlier estimate of 7% owing to a strong Q4 performance. It is reassuring to know that India continues to be the fastest growing major economy and should remain so in the next few years. Digital payments continue to grow at a fast pace with transaction volume growth of 56% year-on-year in FY23, which is expected to grow 4 times by FY27. Indian credit card industry continues to grow at a steady rate. As per RBI June 2023 data, there are around 89 million cards outstanding in the country. In June 2023, credit card spends have been at 1.37 lakh crore, marginally lower than record high 1.4 lakh crore achieved in May 23. Coupled with highly underpenetrated nature of Indian credit cards market, this underlines the continued relevance, attractiveness, and long-term sustainability of the credit card business. Many progressive regulations have also reinforced the growth prospects of the industry. These have balanced the healthy competition in the industry with customer-friendly measures. RBI Payments Measure 2025 outlines that card acceptance infrastructure will increase to 250 lakh touch points, which will further boost transactions in India. Being the largest pure-play credit card issuer in India, SBI Card is at the forefront of industry growth by driving up the penetration of credit cards in the country. As an agile organization, SBI Card continues to assess and explore opportunities that can support the growth momentum. With improving consumer sentiments and stable macroeconomic conditions, our aim has been to leverage this window to test and expand the variety in customer base while being prudent. During Q1 FY24, we have introduced Paytm SBI Card on the RuPay network, thus offering more choices to our valued customers. We have started rollout of SBI Card issued RuPay credit cards on UPI platform on a limited number of PPAPs and will soon be expanding it to other apps as well. Over a period, we expect this to be a significant contributor to our transaction volumes. We continue our investments in technology. Our app platform, available both on Play Store and App Store, was revamped this quarter by enhancing the UI and UX to provide ease of navigation with access to several servicing features like digital KYC and cross-sell features. Our app has been downloaded by 13 million gross users with 7 million unique monthly logins by customers. It has been rated 4.5 out of 5 on Play Store and 4.6 out of 5 in App Store. The app is being revamped in a phased manner with several more features to be rolled out throughout the year. Let's now look at SBI Card's business overview in Q1 FY24. During this quarter, SBI Card pursued and achieved strong growth across most key business metrics, once again demonstrating resilience and sustainability of our business model. We crossed 17 million cards in force milestone. Our SIP stands at 1.73 crores with a growth of 21% year-on-year. This market share is at 19.6% in Q1FY24. Our new accounts in Q1FY24 stand at 10.97 lakhs with a healthy 22% year-on-year growth. The current quarter saw a moderation in growth in line with our experience during Q1 for any fiscal. Our share of new account sourcing from bank and open market channels in Q1FY24 stands at 54% and 46% respectively. We continue to leverage the network and the customer base that SBI has to offer. We endeavor to keep our market share in net card additions at around 20%. Our card spends growth has been strong, registering a growth of 24% year-on-year at 73,913 crores. In fact, spends in Q1FY24 are the highest ever quarterly spends for SBI card, superseding the performance we achieved in the previous quarter. Retail spends have contributed 58,347 crores with 28% year-on-year growth, thus making it the best ever quarter for us in retail spends. Corporate spends have been stable and have contributed 15,565 crores with a 10% year-on-year growth in line with our measured approach for the segment. Our spend per average card has grown from rupees 1,70,000 in Q1FY23 to 1,73,000 in Q1FY24. Specifically, we have seen a healthy growth in spend per average card for our retail spends, which have grown from 1,30,000 in Q1FY23 to 1,37,000 in Q1FY24. During Q1FY24, spend growth has been driven by growth in categories such as travel, dining and entertainment, apparel, education and utilities. Online spends continue to be robust with a share of around 55% in retail spends. POS witnessed faster growth than online in Q1FY24. Our market share in card spend stands at 17.8% in Q1FY24. With robust card spends, we have also seen a healthy 30% year-on-year growth in receivables too. Our receivables have grown to rupees 43,271 crores as of June end. I would like to highlight that our share of interest earning receivables has grown to 62% in this quarter versus 61% in Q4FY23. Our revolver assets stayed stable at 24% and EMI receivables were at 38% of the portfolio. Most importantly, our receivables per card have grown to 24,949 in Q1FY24 versus rupees 23,202 in Q1FY23. Coming to the financial performance in Q1FY24, our total revenue in the quarter is at rupees 4,046 crores, registering a growth of 24% year-on-year. In Q1FY24, our revenue from operations is 3,912 crores with 26% year-on-year growth. Interest income forms a significant share of our revenue from operations, which has been growing steadily. In this quarter, interest income contributed 46% share and has seen a growth of 30% year-on-year. Our PAT for the quarter, that is Q1FY24, stood at 593 crores. Our cost of funds during the quarter increased by 37 basis points. We expected the short-term rates to be lower and ease curve to normalize. However, higher than expected short-term treasury rates and opportunistically borrowing more long-term debt as long-term rates eased off resulted in our cost of funds being higher by 37 basis points quarter on quarter. The long-term borrowing, as a result, increased from 35% to 37%. Given the predominantly short-term nature of our assets, we would be comfortable with the long-term borrowings at the current level. During the quarter, we were also able to mostly transmit the increase in cost of funds to our asset book, resulting in increase in the yield on loans by 20 basis points, helping us keep our NIMs almost stable as at Q4FY23. We expect the cost of funds in Q2 to be marginally higher by 5 to 10 basis points from Q1. NIM is expected to be stable next quarter. Our asset quality. As of Q1FY24, GNPA marginally increased to 2.41% from 2.35% as of last quarter. Our gross credit cost increased to 6.8% in Q1FY24 from 6.3% in the last quarter. As we shared with you in the last quarter's earnings call, our credit cost was elevated on account of stress emanating mainly from 2019 closing. We have noticed that the delinquency behavior for the 2019 vintage has been relatively worse, considering its weightage in the portfolio. The lifetime delinquency behavior for this vintage deviates from the expected lifetime behavior. We have identified the stress segments and have taken suitable portfolio actions. We have also intensified our collection efforts for this cohort. While the overall new sourcing quality is within the desired delinquency band, we have proactively discontinued sourcing of less profitable low-limit cards, terminated a few pilots based on early signals, increased documentation and verification requirements for certain low bureau score segments, and reduced sourcing from certain geographies. We also took portfolio actions on potential high-risk segments by reducing their credit limits and tightened eligibility criteria for cross-sell to these customers. The collection efficiencies for the industry, particularly in the later buckets, have not come back to the pre-COVID levels, which can be partly attributed to the change in customer behavior. We reviewed our collection strategy and intensified field efforts, including enhancing the field infra in geographies with higher stress portfolio. Our collection teams continue to leverage digital tools available. We are certain that the gross rate cost has peaked in Q1FY24. The improved flow rates in the month of June, that is June 2023, resulted in lower credit costs as compared to April and May months. Initial trends in July also indicate continued improvement, and we expect the credit cost for the coming quarters to be on a downward trend. In addition, the delinquency for our recent sourcing vintages is better and in line with the expectations. As the weight of these recent better quality vintages increases in the portfolio, the overall portfolio quality will also improve. As you would have noticed, we have increased the sourcing from self-employed and Tier 3 and Tier 4 segments in the last few years. The delinquency behavior for these segments has shown an improved trend over the last few years. The increase in prosperity and therefore the increased consumer demand from Tier 3 and Tier 4 cities in India will continue to drive growth for the financial sector. Government initiatives, growing consumption, and thriving SME enterprises in these cities encourage us to focus on these cities. Access to SBI network in these cities gives us an edge over other players. We are closely monitoring the performance of this loan segment and will calibrate our approach as and when appropriate. With the steps taken in Q1 and encouraged by the results, we expect credit costs for the second half of FY24 to trend back into our target range of 5.8 to 6.2%. Our cost to income for Q1 FY24 is at 56.4%. We saw an improvement in cost to income ratio to 56.4% versus 58.1% in Q4 FY23. Our profitability ratios continue to be robust. In Q1 FY24, despite an elevated credit cost, our return on average assets was at 5.1% versus 5.4% in Q4 FY23. With steps taken to reduce the credit cost and increase share of digital sourcing over the next few quarters, we expect to maintain a healthy ROA going forward. In summary or in conclusion, India's growth story remains intact and the domestic consumption is encouraging. At SBI Card, we have always maintained an agile approach and taken well-calibrated measures to ensure sustainable and profitable growth. We embarked on this fiscal year on a positive note, as can be gauged from our strong performance across most key business parameters. Amidst the ever-evolving macro environment, we stay focused to take advantage of the immense growth opportunities that the Indian credit card market continues to offer. Yashasri, we are now open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Also, participants are requested to restrict their questions to 2 at a time. They may join the queue back for follow-up questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Hello, sir. Hi. So, my question is on credit cost. So, the 2019 customers, what would be their rough contribution to current outstanding? Any rough idea?
Yes, this is Shantanu here. The current composition of our portfolio is about 16%. So 2019 sourcing is about 16% of our NPA.
Okay. And what would be the range of credit cost in the near term? So obviously you've taken a lot of portfolio action. So say for the next 2 to 3 quarters, for the rest of FY24, what is the range of credit cost we can expect over the next 3 quarters?
So as I said in my speech, I think we started seeing a positive trend now, in the sense like we started seeing decline. Month of June, we had a benefit of looking at the entire month of June. It was better than the previous month, like April and May. Essentially, it means like it has peaked in the first quarter up to May. The credit cost monthly we are monitoring now very closely, so it started declining. We are confident with the kind of measures what we have taken and initial trends what we are seeing. After September quarter, we will be back to our target range of 5.8 to 6.2%. So you can actually estimate like where we will be. We are at 6.8% in this quarter, but after a quarter we will be in the target range. So you can estimate like how it will trend.
Okay, got it, sir. Got it. And sir, my last question is on margins. So say rates are cut at some point in time, not immediately, but RBI cuts rates. Then how will your margin behave, not only from a cost of funds perspective, but from yield? So how soon do you pass on rate cuts to your customers in terms of yield? How will the yield side of things move?
If you look at our past record, whenever the rates are declining or whenever the rate environment is a very benign kind of environment, we have always been the beneficiary in terms of improving mix. That has been the case. Because of the lag effect, like the way what you are seeing now, when the rates are increasing, our liability is getting repriced faster, but it takes some time for us to transmit the rates fully to the asset side. But exactly it will work in our favor when the rates are declining. So any declining, while I'm not hazarding any guess as to when RBI will be reducing the rates, but that will be very positive for our market.
Okay, sir. Thank you. Thanks a lot.
Thank you. We have our next question from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, thank you very much for the opportunity. Good evening, everyone. So first question is on, again, the credit cost. So we have identified this 2019 cohorts where we are seeing stress. So can you talk a bit about what is the profile of these customers, what went wrong there, and what confidence do we have that the incremental sourcing we have done maybe in the previous years or the years after that, we are not going to witness the same or similar stress in those cohorts?
So this has been something that we've been very focused on in the last 3 to 6 months. Incidentally, I joined in April, so just about 3 months ago, and ever since I've been here, we've been running diagnostics of the problem and collectively thinking about the actions to be taken. Some of them were already underway well before I came. They take some time to execute, and then results also take some time to show up. But that's been happening, and we're seeing green shoots already. But to answer specifically what we were seeing in 2019 sourcing was that the behavior of this cohort was somewhat different from what we noticed in the prior or subsequent cohort. In terms of both the peaks that this particular cohort witnessed, which is around the 30-month mark, the level of that peak and the speed at which that peak was crossed and the delinquency behavior then tapered out. That took somewhat different trajectory compared to the other cohorts. This is not very different from what we would have expected from the model, but it took some time for the discrepancy or anomaly to show up because it was coming just after the pandemic. So that point of time to distinguish this portfolio from the others was not, or this section of the portfolio from the others wasn't very easy. But as and when we did it, we started taking those actions in terms of line decreases or intensification of collection efforts. In terms of the other subsets of this segment, some of the charts are available in the investor deck. You can see that alongside this 2019 portfolio, there is a component of a portfolio that comes from self-employed. So in this duration, in the last 3 or 4 years, the contribution of the self-employed segment has gone up by about 4 percentage points in the 3-year period, 3.5-year period. Similarly, at the same time, the delinquency behavior of this segment has actually improved. And there are 4 other similar subsegments of this our portfolio that we call risky, whether it's Cat A versus Cat B in our salaried segment or whether it's the under 30 portfolio. All of those have moved towards, we moved towards the higher risk component as we try to generate revenue. but the riskiness of each of these segments has improved in the last 3 or 4 years. So that's a heartening trend, and as the portfolio matures and we get higher and higher components from our more recent sourcing that we find is more suitable and giving us much better delinquency performance in terms of lifetime behavior, we are encouraged that the overall delinquency of the portfolio will improve, and it's on that basis that we are giving you the comfort that Anita just spoke about 2 minutes ago.
But anything specific here? Is it self-employed? Was it open market or bank sourcing, which the cohort came from? Any color you can share there? Or it's a mix?
It's actually a mixed bag. We can't really point out towards only one component, but whatever subsegments we're seeing, whatever cohorts we're identifying, and the lookalikes of those cohorts that we're seeing in the rest of our portfolio, those are the ones we're taking actions on from our portfolio actions point of view, or from our marketing actions point of view, or from our collections action point of view.
Got it. Okay. The second question is with regards to the growth trajectory. So Mr. Rao talked about this intervention as well. You have also put in slide 6 to focus on profitable segments, cutting off credit limits, and also sourcing maybe some of the pin codes you're not sourcing for. How do we see the 1 million net card addition target per quarter in that context? So should we be expecting a lower number in the coming quarters?
Yeah. I think we are still mindful of clocking that 300,000 per month and over a period of a quarter, 1 million kind of thing. Only, as rightly said, like some of the steps, the recalibration, etc., what we have done. And the typical seasonality, what we see in Q1, combined with that, you can see like it has resulted, but there is no change in our aspiration. But only thing is, it will take a month or two before we hit that kind of mark again. At least the initial aspiration will be to reach 300,000 in a couple of months, and then of course gradually increase the run rate. But we will try to be more careful, and we will try to balance it with how the credit cost is also behaving. So we'll be mindful of both.
Got it, sir. Thank you very much. All the best.
Thank you. We have our next question from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. I just wanted to understand your delinquency chart on slide 15. So how exactly do I read it? So all of them are up, they reach their peak in 24 months, on book and then go down. But you're also saying this is ever 90 plus. So shouldn't that just always be increasing?
So this is standard industry slide, and you will notice the shape of the curve is very similar to what you might have seen elsewhere.
I
meant lifetime of the card is more different.
No, sir. I just meant that, say the 30-month on book number should always be higher than the 24-month on book, which should be higher than 12-month on book, because this is ever 90 plus. So I'm not sure if I'm understanding this chart properly.
Yeah, so here this is an incremental number. You are right. If you actually do cumulatively, it will continue to grow. But the point here that we wanted to show was that the maximum peak after build-up of assets happens at around 24 months, and after that the incremental number of people coming into 90 plus keeps on going down, and you just manage that portfolio. So that this chart is representing that number. And it's also indexed, so it's not the absolute value, it's index value.
Got it. Okay, so it's an incremental number of 90 plus. Okay.
Yeah,
but in that case, the dotted line, which is CY19, now it's been like 4 years, right, since it's CY19, and that number has come down anyway. So I don't see why it should impact us in 2023.
Yeah, it's about 16%. It's about 16% of our assets, and about slightly over 20% of our NPA. So that's a slightly disproportionate number. The incremental amount of credit cost that we're carrying because of this particular cohort is about 14 basis points.
No, sir. I don't think I've communicated my question well. I'm just saying that, so if I compare the CY18 line and the CY19 line, they're probably pretty similar. But last year we did not see any sort of hit due to the CY18 line. But this year we are seeing the hit from the CY19 line. So I'm not really understanding why.
Yeah, it's a composition of the cohort in the overall asset. So CY18 ran off quicker, and it is not contributing significantly to the overall rate cost because it's much smaller in value. 19 is 16% in our value.
Got it. Okay.
The chart that you see on the slide, Piran, is at the portfolio level doesn't show as Shantanu pointed out, the percentage contribution in the portfolio. We're just behaving a portfolio behavior. It's a behavior of putting ever 90%, 90 plus in percentage. When you put this in context to the percentage of this vintage in the portfolio, that's where it starts to show up in a higher rate.
Also, the other point of putting this chart was to also show you that the vintages which are belonging to 2020, 21, 22, which are the latest vintages which we have acquired in last 3 years, are almost on an index level at the peak of around 0.59 or 0.6 compared to what we were acquiring earlier. So as these new vintages build up assets, automatically the weighted averages will start to come down.
So the point of arrival is that the subsequent cohorts are peaking earlier and tapering faster.
Okay, got it. And the second one, just for Rashmi, now if RBI does not hike any more, cost of funds should be stable, or do we see that increasing? And in the last 1 year, how much have we increased our EMI yield by?
EMI yield has gone up about 120 plus basis points. The EMI yield, the yield on our EMI book would have gone up by about 120 to 150 basis points. Even if the RBI doesn't increase the rates any further, as Mr. Rao called out, we do expect the cost of funds to go up this quarter as some of the other liabilities they come up for repricing, both on the short term and as well as on the long term as well. Remember, our long term book, which you would have borrowed 3 years back, is at a much lower price. So factoring all of that, we've called out at about 5 to 10 basis points increase in cost of funds in Q2. I'm hoping post that, as the rates kind of become normal for the second half of the year.
Got it. Okay, that's it from my end. Thank you and all the best.
Thank you. We have our next question from the line of Abhishek M from HSBC. Please go ahead.
Yeah, hello. Thanks for taking my question. So I had a follow-up on this yield on EMI. How much of the 120 to 150 bips would have translated already, and how much would get repriced as we go along?
The number that I called out is the translation of the cost of funds going, the increase in cost of funds being passed on the EMI book.
No, I meant the increase in yield on the EMI book 120 to 150, that would be applicable only the book sourced through over the last, let's say, 2 to 3 quarters, right? So there would be a part of the EMI book which is not.
That's right, yeah.
Okay.
So what you would like to know is?
So what I would like to know is that what part of that EMI book is yet to reprice?
Oh, so we can't reprice our existing book at all. The EMI loans are fixed rate loans.
Okay, see, Abhishek, what happens is, the nature of the business is we extend only fixed rate kind of loans, so they will be fixed for the period or tenor of the loan. But every month we make certain disbursements, the spends getting converted into loans, or otherwise some encash kind of loans being given, or flexi pay, or BT balance transfer, etc. That gives an opportunity to transmit the rate increase. So it takes a few months for the entire portfolio, because considering the life of the portfolio, which is around maybe 11 months or less than a year, it takes that kind of time to for the entire portfolio to get repriced.
Got it. So 11 months to a year is the
slightly more specific on the flexi pay and subvention. More than 80% of the book would have already got repriced because it is, as I said, it is average tenor is 9 months. So it's only some of the 18-month book would be left. In cash is where the repricing is still continues to happen because there the average ticket size, average tenor is close to 33 months.
Exactly. Okay. So how much of that Encash book would have been at new rates? Let's put it that way. Anything in the last 2 quarters, basically.
Actually, less than 12 months is fairly less because personal loan ticket size is primarily 24 months and above. So the new addition that is happened into that book or incremental book is at a higher rate. The replacement cycle will continue to happen over a period of time.
Got it. And what part of that EMI is on Encash versus the other two, FlexiPay and Subvention?
We have not declared the breakup of the all three.
Got it. Okay, no problem. So that was on yields. The second one was on this collection teams which were enhanced in certain geographies, etc. Do you think this will have a sort of follow-on impact on costs on an overall basis? On OPEX, I mean?
So, while we see this structure, we are mostly focusing on the free channel, if you would have called earlier. And what we do there is that the full model is based on variable cost. We only kind of pay when the money comes in. So all this infra addition is actually done on the free channel, which is basically a variable channel. So we are not out of the cost.
While the absolute collection cost may go up, but there are obviously benefits coming in as well in better collections and better recoveries as well. So we are mindful of that number.
Got it. Okay, thanks. Those are my questions.
Thank you.
All the best.
And also better collection efforts lead to lower NGDs as well, that helps future credit costs.
Sure. Thanks for that.
Thank you. We have our next question from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, good evening, everyone. I just had a follow-up question on this 2019 cohort. I just wanted to understand, before these accounts slipped, and I assume that these are spends made by those customers now, they would have ideally slipped into a revolver book and then subsequently become an NPL. So why haven't really been seen any impact on revolver because of this whole slippage, and why do they continue to be there in the system? I mean, they should ideally probably be ejected out after they become an NPL. And that's all from my side.
So I think, Bhaskar, the kind of behavior what we have seen with regard to this cohort is, while they have been maintaining some payment record, the moment they become stressed, particularly with the moment they cross 30 plus, we have seen behavior where it is a straight flow practically. That means our ability to normalize from this segment was limited. That is what we have noted. So that means you will not see, it is not like the regular revolver where they continue to pay maybe more than 5%, 10%, 20%, but it is just like an inability to pay, which will be more like a wash in the revolver. So that way you won't see a significant increase in the percentage of revolver because asset is also growing on the other hand, other side. So you won't see a kind of very big increase on account of it. But it is only the segmental behavior when you track only, then only you will come to know that actually there is some, it's not a regular revolver, it is more like a delinquent revolver.
And the fact that we continue to see that stress, does it mean more and more borrowers from that pool continue to default? Is that how it works, or is it the same borrower making some payments, continue to make higher spends? Is that the reason why this number continues to be elevated?
So for the last 2 quarters, as we identified these accounts, we did see some increase, but if you look at the slide which talks about the credit actions that we've taken, obviously we've taken steps to now make sure that their utilization of the credit card limit and therefore the addition to the stress reduces. And that's where we are hoping that as that stress reduces, and the collection efforts help us in recovering the already lent out money, is where it will help us reduce the credit cost.
So we are very careful about 2019 segment. Okay? So and there is a deeper consciousness as if the customer starts to revolve, we go after that customer at the initial stages itself. As Sir said, if they are going through collection efforts are higher, trying to identify localized, do credit declines, credit limit declines in some of those segments. So there are multiple actioning which is happening. We are restricting ourselves from cross-selling products to these customers at this stage. So that's how the whole asset percentages has come down to mid-teens for this segment, and it will continue to go down in weightage as we grow the good asset, which is coming, as you can already see from that slide 15, which is coming from 2020 onwards vintages. Okay, so that is the way that we are looking at it. Those new vintages, as you see, they are peaking at a lesser rate, but that also, along with it goes, is that their revolve rates are also lower, which we are fine with, because the idea is to keep the revolve rate. If we have the revolve rate at 24% and get the credit cost within control, we can continue to grow from that by working on the term lending portfolio.
Okay. Got it. Thanks. That's all from my side.
Thank you. We have our next question from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. So any sale to ARC this quarter or anything anticipated in near future?
So we keep looking at these opportunities. As and when we think it makes more sense to sell up our portfolio to the ARC, we will do that.
So nothing as on today?
So if your question is, did we do anything this quarter, the answer is no.
Okay. And my second question is somewhat pertaining to the previous question. So look, if I look at systemic delinquencies on the credit card portfolio, then they have been clearly rising, at least for the banks. So in such a scenario, I mean, we did highlight the fact that incrementally the new portfolio has been showing a decrease in delinquencies. But then in such a scenario, generally it tends to be like that in a scenario where delinquencies tend to rise, your revolver book tends to pick up. So can you just give a color on how the revolvers look like from here on?
Your question is that the delinquencies are increasing and therefore the revolver should go up.
Yeah, correct.
No. So the way that you look at it is, if it is, we only look at, so what is a revolver? Revolver is a customer who pays up to 5% or more on the outstanding balances. Okay. These are the people who are current also and they pay interest. So they are the people who are good revolvers, and that is what we have been stating in earlier calls also, that these days even that revolve behavior has changed. Earlier people used to be, they will be revolving 6, 8, 9 times in a year. Now people revolve maybe 2 or 3 times as and when the short-term fund requirement is there. Okay. So people keep moving from transactor to revolver to transactor, so that happens. If the customer becomes delinquent, misses a payment, in any case after a point of time, whether it is a 45th day or 60th day, the card gets blocked. And we will not allow the customer to spend further onto the card if the earlier payments have not come. And in any case, after 90 days, it becomes stage 2, stage 3. So that is a very different value compared to the overall amount that you look on revolver. So revolver is a very different ballgame altogether.
Okay, then how is the color on the revolver book going forward? We are currently at 24%. We have been around that percentage for a while now. So how do you see this going forward? So,
good point. So on the revolver book, what we have seen is that even when we look on a month-on-month basis, it is stable at around, there's not much variation. It is hovering at around 24% or so, plus minus 20-30 bits in that scenario. We have seen as the new portfolio also maturing, because as you see those 2020, 2021 good customers maturing. Now this is a trend which was shown in slide 15 of 90 plus. But we are seeing revolving behavior in those segments also. And this time the revolving behavior is that the customer would revolve for 1 or 2 months and then again become a transactor. So, which is a very good sign. So it is stable at 24%, at this point at 24%. We don't foresee any change, at least going further in next 3 to 6 months. And then we will keep you people posted if we see any changes in that behavior on the positive or other side.
Okay, that helps. Thank you.
Thank you. We have a next question from the line of Prashant Kothari from Pictet. Please go ahead.
Yeah, thanks for the opportunity. I just wanted to understand the life cycle of the customer. I mean, why does it take so long time to even kind of understand that this was the kind of the bucket of customers which is going bad, like the portfolio which kind of started in 2019. It's 4 years old, and now we are understanding, recognizing, realizing that this was a bit of a weak bucket. Why feedback mechanism so kind of slow? And secondly, is this the case that will take about 3-4 years?
Hello, sorry. We couldn't get the last part of your first question.
Yes, so the question is, why is the feedback mechanism so slow? Because what I assumed was that the feedback would be very fast in the credit card business, that you will know which customers are bad or good, and therefore you can take corrective actions much sooner. But why is it so slow? So that is the first part of the question. And second, related to that is, if the feedback mechanism is this slow really, then how do we kind of keep the incentives aligned in the business? Because people are getting rewarded maybe on, I don't know, maybe on monthly, quarterly, yearly performance. But if the problem takes whatever 3-4 years to actually emerge properly, then how is the incentive system aligned internally?
I take the first part of the question, if I understood correctly. Your question was, why does it take so much time to identify the problem areas and for the actions to be taken and the results to be seen? If that's the question, then that's especially true for the 2019 vintage from the chart that we were just looking at. And I explained some of that reason earlier, but I'll elaborate further. See, until that portfolio was peaking at 2019, between the 24 and 30th month period, the aberration wasn't there. The aberration was the way that curve has then flattened out or come down. And that was the aberration, and that we should have picked up sometime in 22. But because we are coming out straight out after the pandemic, remember 21 was still a pandemic year. That is the year in which the second wave happened. So the early part of 22 is when we have potentially found the problem and then acted on it. But it wasn't so apparent at that point of time because the entire portfolio was showing some stress at that point of time. This aberrant behavior became more apparent later in the year, and that's when the action was taken. So that slight delay is on account of us coming from a pandemic period to a non-pandemic or normal situation. I hope that answers some part of your question.
Okay. Yeah, thank you. And how do you keep the incentives aligned? I mean, if it is taking 2-3 years for us to understand where the underwriting is right or wrong, how do you keep that incentive aligned?
That there is.
You are asking about the incentive for the sales people?
Yeah, incentives for the sales people, incentives for the underwriting team, that they are taking the right decisions when they are getting new customers in.
Okay, so underwriting teams are not on variable incentives or anything.
On an individual decision. So on the incentives, the sales people are on incentives, and there are strict metrics that we measure their performance on, and their payouts are made only after a 4 MOB performance of the account that has been sold by them. The underwriting team is not on incentives, but there is no individual decisioning that's happening in the underwriting team. There are scorecards and models that are being used for underwriting our customer.
Mr. Kothari?
Yeah. All right. Okay. Thank you much.
Thank you. Ladies and gentlemen, we request you to restrict your question to one at a time. You may join back the queue for follow-up questions. We have our next question from the line of Gao Zizhuan from Schonfeld. Please go ahead.
Hey, sir. Thanks so much for the opportunity.
We are unable to hear you clearly. Please use your handset.
Am I audible now?
Can you go ahead with your question?
Yeah, thanks so much. So just some data keeping questions on this 2019 cohort. Just want to understand it a little bit more. So can I can you provide us with, number one, what's the revolver rate of that cohort as of this quarter? And number two, what's the credit cost of that 16% book for this quarter, please?
The second question is, we want to know what is the credit cost for the 16% 2019. We didn't get the first question. You want to know as to what is the
what's the revolver rate? So book level,
revolving rate for the 2019 credit cost for the 2019. We do not usually give out revolvers by vintage. So I think that's something that we won't be able to share with you.
The second part of the question is, I think you answered earlier as well. The 2019 vintage contributes about 16% of our assets and over 20% of our NPA, and is adding about 14 basis points to our credit cost as we speak in the current quarter.
Okay, sorry.
I have not seen that. You would have been voting.
Okay. Sorry, on the revolver rate for the cohort, I appreciate that you can't share the number, but generally, is it higher or lower than the overall book level?
Please give us time. We will look at the data and tell you. Just give us time.
Yeah, sure. Thank you.
Somebody from the investor relations team will reach out and share the data information with you.
Thank you. We have our next question from the line of Rahul Jha from Bay Capital. Please go ahead.
Yeah. So, my question is, the guidance that you have given on credit cost, is it on the gross basis or on net basis?
Talk about gross basis.
Okay, that's it. Thank you.
Thank you. We have our next question from the line of Saurabh from JP Morgan. Please go ahead.
Sir, just want to know what is the approval rate right now for new credit card sanctions in the open market book, and what was it let's say pre-COVID? That's the only question. Thank you.
So we usually don't give segment-wise or open market versus banca approval rate. Yes, we can tell you that the open market approval rates are higher. They run anywhere between, on an average, 55 to 65%. They will continue to go in that range, and they are broadly similar to what we had pre-COVID numbers. Okay. Now you have to also look at this in light of the sourcing pattern and the way the customer acquisition has completely changed now. Okay. So at the initial stage itself, after taking some 4 or 5 fields from the customer, we are able to either give a soft approval, soft decline, or a referred status to the customer. Now, after that, once the application is fully filled, then you look at what is the status of the customer. So it is not about, it's become a 2-step thing to be able to start digitally to reduce the cost. So approval rates have to be looked at a very different line altogether.
Okay, and during 2020, 2021, fair to say that this would have been maybe lower, 30-40%?
No, nothing of that sort. It is actually these days the filtration we try to do upfront itself. The modeling status, and then we try to do after 4 or 5 fields. If the customer is credit tested or he has let's say a CIBIL score already, a whole lot of models go upfront itself to be able to see whether we want to go ahead with that customer or not, rather than waste our time where we don't want to approve.
Okay, so your approval rates haven't changed through 2020, 21, even today.
No, the point I'm trying to make here is that they have changed. However, the context and the situation has completely changed. So today, for example, if you look at completely only online, the approval rates would be in the range of, let's say, 10 to 15%.
Okay.
Okay.
Another thing is, just to supplement Girish, in addition to the bureau score, I think we also started looking at some alternate data as well. Wherever it is available, maybe through the partnership or otherwise, now at least we've started looking at even account aggregators. So that way, I think the percentages will keep only that much, but underlying it has changed over a period of time as compared to pre-COVID period. The kind of extra due diligence which we do for some maybe segments having low scores, etc. We do that extra due diligence in terms of validating the information or being sure about the process.
Okay. Thank you, sir.
Thank you. We have our next question from the line of Dhaval from DSP. Please go ahead.
Thanks for the opportunity. Just one clarification. So you said about 14 basis points is due to the 2019 cohort. Is that correct? So about 60 crores.
That's right.
Okay. And the subsequent. Hello. Sorry.
Yeah. Go ahead.
Yeah. No, and the other point was just the next quarter you expect somewhere between 0 to 14 basis point as the impact, and the following quarter it should be back to BAU. So about 6.2, 6.3% kind of gross credit cost.
Yeah. So this quarter, after this quarter, we expect to come back to our target range. That's right. The current quarter.
That means
September quarter.
Right. So my point is that it won't. So 14 basis point is the maximum impact that we can see in the September quarter. That's the point I'm trying to drive.
I think the trajectory will be credit cost will only be coming down. In order to reach even the target range, it has to come down in this quarter itself, which we already shared. Like a month of June, we have seen good trend, and again July also it is holding good. So this gives us the confidence to say like a September quarter overall gross credit cost will be lower than June quarter. But reaching the target range will happen only by OND.
So we believe it has reached in the month of May and it has started to come down.
Got it. Thank you and all the best.
Thank you. We have our next question from the line of Krishnan ASV from HDFC Securities. Please go ahead.
Hi. Very good evening. My question is partly related to what Prashant asked earlier, which was about the feedback mechanism being too long compared to what conventionally we would think, given the kind of science and the kind of analytics that's now available on credit cards. I thought this feedback loop would be shorter. Having said that, if you say that this was indeed not something that you were seeing, to one of the earlier questions by Anuj, you said there wasn't too much different about the 2019 cohort in terms of origination. It was a mixed bag, both open market and banca. So the cohorts that we originated thereafter, did we get them right just by pure accident, or it seems that if there was nothing different about the 2019 cohort compared to the others, then what is it that we got right and how accidental was that?
2020, if you recall, was the COVID year, and therefore, like every other organization, we also had tightened our credit norms. And therefore, you will see that 18 and 19 behaved almost similarly. 18 peaked a little higher than 19 and is now obviously came up earlier, and the percentage contribution was lower as well. But the benefit that we got was that the COVID made us all tighten our credit norms. And as a result, you see 20 perform better. Learning from 20 helped us fine-tune, and we also fine-tuned our models post the COVID once the market opened up, and we also started sourcing from the market. We fine-tuned our models, taking in the inputs from the COVID period and prior to that as well. And that helped us in the quality of the portfolio post that being better.
That's all right, Rashmi. I think my limited point was, given that much of the market has matured towards early warning signals, right? 4 years is kind of far too long for a portfolio to be bleeding and us not knowing about it in terms of why is 2019 cohort behaving very differently. What is it that we did, and where is it that you tweaked it tighter? That was the limited point I was trying to get to. Given all this.
Not that.
Yeah, please.
it's not that we did not see the EWS. Obviously, we have a strong EWS mechanism, and we do work on that. But as Shantanu pointed out, that the early years on this particular portfolio, it was also colored by the COVID behavior. Remember that we were required to give restructuring to our customers, etc. And as a result of that behavior, in a way, because of the restructuring and the COVID, it camouflaged the real behavior of this portfolio. Last year is when, and we called that out in the previous earnings call as well, at end of last year, calendar last year, is when we realized that the signal to EWS for this particular portfolio is telling us that the behavior is not as per where it should be, 36 MOB, and that's where we started taking actions on it.
Thank you.
So through the cycle of the customer, we do keep monitoring the EWS, but as we said, it got camouflaged under the RBI RE and the COVID period.
Thank you. We'll move on to the next question from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good evening. So when we speak of the tier 3 and other cities, how many total cities are here? And do we plan to change these Visa or MasterCard cards with RuPay credit cards which are acceptable on UPI given the lack of POS infrastructure in these cities? That's question one. Second is, in the open source customers, how many customers already have a credit card? And if we have a similar number for SBI sourced customers? Thanks.
On the second one, on the sourcing strategy of open market is to leverage the existing carded customers, and so today, primarily we target customers who have been carded by the industry. We do not really disclose, or we do not really publish the data around the percentage of carded customers in either of the segments. But primarily the strategy is to use the digital channels, use the co-brand sourcing channels to provide these customers with an alternate value proposition which is compelling enough for them to have an alternate card in their wallets. Similarly, for the banca channel, the strategy is to also reach out to some of the non-carded segments because of the relationship with the bank, which makes it compelling for the bank to have another relationship apart from CASA or any other relationship that they have with it.
On the tier 3, tier 4, we are already giving cards there which are RuPay cards. So customer now with the new draft guidelines of RBI, the customer preference will also get taken into consideration. And as MD mentioned in the opening remarks, that we are already going live with UPI on RuPay cards, and we are testing it. We have not opened it for the large TSPs, but the whole RuPay portfolio, the testing is taking place. Once that happens, we believe that we will get more transactions in tier 3, tier 4 towns from these customers.
How many tier 3 and other cities are we catering to? That question is still unanswered. How many cities are there?
So we go more than close to around 200-250 cities in overall scenario. Okay. So these days the definition of tier 1, tier 2 is that tier 1 is the top 10, and tier 2 is what we look at the state capital, and beyond that we say tier 3 and tier 4.
It's also a graded approach, so it's not that you're fully operational in every city, and we keep revisiting that strategy every now and then depending on the penetration and the portfolio quality.
Sure, best of luck.
Thank you. We have our next question from the line of Abhishek M from HSBC. Please go ahead.
Yeah, hi. Thanks for taking the follow-up. Just on this business development incentive income, like last quarter also a lot of conversation happened, and What I want to understand is when does the measurement start? So when does it start at the beginning of the year, and then your partners see how much volume you are generating for them, and then they pay you an incentive. So from when does this measurement start?
On the business development incentives with these partners, some of these deals are long-term deals